All right, futures edging lower, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Carol Masser. Katie Greifeld and Sonali Basak are off today. Bloomberg Open Interest starts right now.
Coming up, a turbulent week in market draws to a close with debates on what's next for stocks, bonds, and central banks. The week ahead brings a slew of economic data as investors search for more signs of resilience in the world's largest economy and riding the AI wave. Chip-making giants, TMC's sales, growth stages, a comeback. We'll discuss what that means for the broader sector. But first off, let's take a look at where markets are trading. As I said, edging lower right now. We have S&P futures down about 1/3% after closing the session in positive territory yesterday. NASDAQ 100 futures down a little more, about 0.6%, and the Russell unchanged. Carol?
All right, Matt. So a little bit lower in terms of the overall trade, but I'm going to take a look at some gainers in today's session because we've got another big media giant actually taking another big write-down. We're talking about Paramount, but we've actually seen this name go higher post-market and then also pre-market, up about 5%. They did have an earnings beat, but nonetheless, that write-down continues in media. We're going to talk a little bit about that as well. Expedia, another travel company, check this out, up almost 9% in today's session. Earnings beat. It did warn of a soft demand, joining a chorus of execs from Airbnb and Booking who have talked about slowing demand, but nonetheless, investors saying, I'm okay with it today. And then Matt mentioned chips. TSMC, world's leading contract chip maker, saw sales growth of 45% in the month of July on strong AI demand, Taiwan Semiconductor, you can see up about 2.25%. We will be watching the semi space today.
Let's take a look at the bond trade because we've seen yields come back to a level where they were last week. Stocks not quite there yet. The 2-year yield back over 4%. That we saw yesterday. In fact, yesterday we saw the 10-year yield over 4% briefly. Right now it's back down to 394, and the 30-year at 422. Next week is busy, as I said, for economic data. We're going to get the New York Fed 1-year inflation expectations on Monday, followed by key inflation data on Tuesday and Wednesday as well. We'll talk about inflation and its effect on earnings with Cameron Dawson a little bit later. We get retail sales data on Thursday, and then University of Michigan consumer sentiment on Friday. We'll be looking at that closely. Joining us now to talk about how all this affects the bond market and the stock market is Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. And Ira, we care so much because it looks like the bond market has been leading the stock market in these huge volatile swings, but we're back at a level that we were before the non-farm payrolls. How does it look to you?
Yeah, so all of these markets are just very correlated and in a more normal way, right? So for basically 15 years, we've had either a QE trade or a QT trade going on, right? Where all the markets were positively correlated. So now you're finally starting to get a little bit of a negative correlation where equity markets fall or some other risk assets fall, and then you get a rally in rates or rates rally, and then that kind of spooks the risk asset markets. But it's all very correlated almost together, as opposed to one market really leading the other. The bond market trade, though, it certainly is now looking like, hey, the Fed really is going to cut. We're not as worried about a reacceleration of inflation, and that's why 2-year notes, even though they're above 4%, remember they're down from 4 3/4 just a couple of weeks ago. So it's a really spectacular rally.
Ira, having said that, is it hard to kind of figure out where we top out when it comes to yields right now?
Well, we're looking at important technical levels. I think that's probably the best thing to do for anyone trading in their portfolio and trying to reposition. So 412 on 2-year note yields is a pretty important level. We do get a 2-year note auction at the end of the month. We had some pretty bad auctions actually the last 2 days in the 10-year and 30-year, but I suspect that a big part of that is because people are migrating toward the front end of the yield curve to get their risk, kind of fear of missing out, and just look, let's just make the 4% carry because yields might be well below 4% a year from now. So people are just trying to get in now. So this rotation toward the bull steepening trade is probably going to not continue forever, right? But there's going to be fits and starts. But I think that's one of the reasons why you've seen better demand in the front end than you have in the 10-year. Now that's reversing a little bit today, but I'm saying in general over the course of the week.
Ira, the 10-year we saw at 394 and the 30 at 422. The 20 at 431. done. Investors just aren't buying this. And yesterday we were talking about Steve Mnuchin saying it's time to kill it. Why is this duration such a difficult sell?
Well, I think there's a couple of things about it. So some is technical. So people, for whatever reason, don't. There's something called treasury strips, which are basically zero coupon long-term bonds, but they're stripped from a different instrument, and nobody strips anything shorter than 30-year bonds. So that's one of the reasons why technically the 30-year, when you look at it, the amount outstanding on the Bloomberg terminal, and you do a DES, the number that you see there isn't really the free float, because people have stripped it and people kind of put them away in their portfolios. So the 20-year, there's a fair amount of supply. It's not something that is a large part of the index, which I think is another big issue. And then its duration is not meaningfully different from a 10-year or a 30-year. So because of that, there's just, people just don't naturally need to buy a 20-year bond, because it doesn't fit their profile for the risk that they're trying to hedge.
Right.
Insurance companies don't buy it, for example. They buy 30 years.
Hey, Ira, just got about 20 seconds here. Next week is a big one in terms of economic data. 2 inflation prints, and we also get a read on retail sales. What do we need to know right now?
Yeah, so if the inflation print just surprises to the upside, then you can wind up having a big snapback in rates, and you can wind up seeing yields a bit higher. But the retail sales number, I think, is going to be key, because retail sales tends to lead the inflation data. So I'm going to be focused on the retail sales data.
See what consumers are up to once again. All right, Ira Jersey, thank you so much. Ira, of course, of our Bloomberg Intelligence team. Well, joining us right now, we want to get the equity side of things and kind of the overall investment thesis on this Friday. Eric Freedman is Chief Investment Officer at U.S. Bank Asset Management. They've got some $480 billion in assets under management. Hey, Eric, good to have you here after quite a week. What's helpful? Here we sit on this Friday in remembering kind of a market environment that can turn on a dime, or an economic report.
Yeah, Carol, great to be here. And your team's done an awesome job this week of covering all these cross currents. I think there's really 2 things that we'd separate for viewers and for listeners. Number one is that we think a lot of the chatter, and I should say the volatility earlier in the week, was a function of that Japanese carry trade. I know it's been that's been covered ad nauseum, but that, the fact that you had the Japanese equity market decline by 20% in 3 days, that's significant. So the aftermath is still being absorbed and digested. We don't think that fundamentals got worse by 20%. We don't think that there's a significant read-through per se, but we have to be respectful of the price action. So again, we would isolate, if you will, the Japanese carry trade issue from the issues that are in front of us in terms of just does this economy grind higher? We think it does. We think it's going to be a gradual slowdown. I loved your poll on Twitter, the artist formerly known as Twitter, on swipe left for soft landing, swipe right for recession. We're more in the soft landing side. So we still think that the bias for consumers will be a gradual easing. There'll be some more differentiation across consumer types, but we're still very bullish on the prospect for diversified portfolios. So really camp us in the optimistic camp, if you will, in terms of what portfolios will look like for the rest of this year.
I should point out, in my poll, swipe left for soft landing, 55%. Swipe right for recession was 45%.
All right. So.
See?
I don't know. I don't know how.
Don't ask me about the standard deviation on that.
Eric, you have a great roadmap for the kind of blow up that we saw this last week. When talking to your clients, you told us you pointed out phase 1 was the triggering, and that was the BOJ and the Fed on Wednesday, then the non-farm payrolls number on Friday. Phase 2 is price discovery, and that's where we have all this volatility, right? And I guess the positioning in terms of the carry trade is in there as well. I'm pretty sure we made a great full screen for this. So there we go.
See?
And then phase 3 is fundamental assessment. That's, I guess, what's coming next. You're concerned about overzealous, let's say, earnings estimates for 2025, right? Is that part of phase 3?
Yeah, it really is. That's a very well characterized, phase transition, the way we're thinking about things. We think that in terms of position squaring, we're kind of not all the way through that, but we're mostly through that right now, Matt. I think the key thing for us is that if you're in our chair, you start to look pretty quickly at 2025 earnings. And based on the great work that Bloomberg does, there's a 14.5% earnings growth baked into the S&P for next year. After a year, we actually had earnings grow likely 10%. That's a pretty high growth rate when we have elections and we still have Fed funds at 5.3%. We're seeing the slowdown in consumers. So what that says to us is, look, we still are optimistic. We still want to own stocks here, but we expect it to be a grind. And some of that differentiation across, again, quick serve restaurants, the things you're hearing about in theme parks and other segments of the market, those are real. Those are starting to really catch up with the broader earnings picture. So where we'd really favor our investment thesis, if you will, is still towards tech, still towards cyber. We think that as long as NDX holds above 17,500, that's a space you can accumulate on weakness. We also would be more aggressive on the equal-weighted S&P. That's a space where you're up in cap, so you're up in quality, but you're also getting more of that fanning out that we think is going to happen still in terms of earnings growth and trajectory. So that's the way we're thinking about it, is that, hey, it's a high bar to hit for next year. It's achievable, but probably comes from more than just tech. And so we want to broaden out some of our exposure as we get deeper into this calendar year.
You know, I actually put together a chart on equal-weighted versus a cap-weighted S&P. It's 1286. G#BTV 1286, if we can pull that up. The S&P has doubled the performance of the equal-weighted, which I guess you could play with the ETF RSP. What triggers a turnaround here, and how do you want to play it?
Yeah, I think a couple things. One, that's an outstanding chart to have. We often talk about this phenomenon visually of alligator jaws that widen and then close. And then you're obviously seeing a very wide jawline, if you will, from from RSP versus S&P. We don't think that's going to necessarily converge completely. We would expect to see those jaws start to close. So I think the catalyst is really this. Number one, we are seeing from a sector participation standpoint more than just big tech working, and some of that is predicated upon credit being very stable. So,
we're losing the feed.
Yeah,
we're losing the feed. The Zoom is falling. Anyway,
Good
we
stuff,
appreciate it. Eric Freedman there, U.S. Bank Asset Management. Great to get your take. Hope we get to have you on again soon. Let's get another check on where futures are trading. We got 20 minutes to go until the open. We're still down 1/4% on the S&P. NASDAQ futures down a little bit more, which is interesting, Carol.
Why?
Because tech stocks, you know, we had such a blowout number from TSMC, right?
Yeah, I'm going to watch the semiconductor space today to see whether or not we get any kind of lift. I also think this is going to be a day. What happens into the close? We've got low volume, probably low activity. It does feel like an August Friday in the summer here. So curious to see what happens.
Finally, a slow August Friday. Let's get a check at what's going on in the stocks right now. The individual names moving ahead of the opening bell. For that, we bring in Abigail Doolittle. Abby, what do you see?
Well, of course, we still have earnings movers to get through. Let's take a look at the shares of Unity Software. Well off of their pre-market lows, but still down about 2.1%. This, of course, is the video game tool maker. They cut their fiscal year forecast after putting up a small sales beat. Into today, it's really pretty extraordinary. The stock down about 65%. There is also a significant 11% bearish short interest on this stock. So bears all over this name right now, just a little bit. Turning to Trade Desk, these shares are higher, and this, of course, is the advertising technology company, up 2.8% in the pre-market. They put up a 12% adjusted earnings beat. They beat sales by 1%, and the guide was better. Now let's go beneath the surface for some of the big movers, the big tech movers, because these are, of course, the stocks that will move the market. On the one hand, we have Alphabet and Apple, both lower. Alphabet down 1.7%, maybe some concerns around search and AI. Apple down 0.9%, I would say, on the possibility of technical selling. This stock still looks like it's going to go sub 200 if the bears get back into motion. On the other hand, we have very small gains from Microsoft, and then, of course, the dividing one, Carol, a decisive one, I should say, NVIDIA up slightly. But if this one were to join Apple and Alphabet, it could really turn into a little bit of a bearish Friday. Right now, just small losses, though, heading into the open.
Yeah, with investors so skittish, it doesn't take much. All right, Abigail Doolittle, thank you so much. Coming up, everybody, a key bellwether for AI demand. Speaking of tech and the semiconductor space overall, kicking into high gear in July, we are talking Taiwan Semiconductor. Sales are soaring, and we wonder, could that kind of help the turnaround in the group that recently tipped into a bear market? Right now, Taiwan Semi, 2.4% higher in the pre-market. This is Open Interest on this Friday, and this is Bloomberg.
Let's Getting out of high interest to look at what's making headlines around the world. An earthquake near the coast of one of Japan's southern islands prompted the government to issue its first ever warning of a mega quake. The country's prime minister called off a planned trip out of caution. Bullet trains ran at reduced speeds, and some chip-related factories temporarily halted production. Ukraine said it carried out a drone strike on a military airfield in Russia's Lipetsk region. The strike marks a fourth consecutive day of Ukraine's expanding incursion into Russian territory. And you know who likes Palm Beach? Larry Ellison. He's buying a luxury hotel for an undisclosed amount in the same Palm Beach enclave where he dropped $173 million on a residential compound 2 years ago. The property has long been a retreat for prominent families, including the Fords and the Rockefellers.
All right, Matt, now he has a couple of places to stay when he goes to Florida. Hey, folks, let's get back to the markets, talk about what's going on in the semiconductor space. The SOX, the Philadelphia Semiconductor Index, dropped 25% from July 10th to earlier this week. They've bounced back more than 2% this week. And overnight, one of the key bellwethers for the chip space, an AI demand Taiwan semiconductor manufacturer, reported revenue rose 45% in July on strong AI chip demand. So you see that one moving up about 2.6% in the pre-market. So let's get to it with Bloomberg Intelligence senior tech industry analyst Mandeep Singh. Mandeep, good to be checking in with you. So what jumps out for you about the TSMC release?
I mean, it's a nice sequential acceleration from their second quarter earnings. So remember, they gave us monthly data and, 45% growth when they guided to low to mid 20% growth for the full year. It just goes to show that, the lead times probably are increasing. And that's good for someone like TSMC because they are the only ones when it comes to leading node chip manufacturing. And I think all the talks about NVIDIA chip delays probably are not getting reflected here. So clearly they are seeing a ton of demand when it comes to chip
How much, Mandeep, I think a lot of people outside the industry don't understand how much production TSMC does for other companies, right? So like NVIDIA doesn't make its own chips. It sends them orders to TSMC and they do it. How much do they do in terms of, the outsourcing of chip manufacturing?
Yeah, so the best way to think about it is all the leading node GPUs, whether it's 5 nanometer, 7 nanometer, most of the production right now is being done by TSMC. For the trailing node chips, you've got other foundries. Now, we know Intel isn't doing well as a foundry, so clearly they're losing business. And typically, TSMC was skewed more towards Apple smartphone business. I mean, that was the biggest portion of their revenue. But right now, it's definitely shifting towards NVIDIA and, the server chips. And it's hard to kind of have a firm read-through on what this print means for Apple, because right now the demand on the server GPU side is just insatiable, and that's what's driving a lot of the ASP growth for TSMC.
You answered my question. I was going to ask you about the Apple exposures, but you went right there. So what about in terms of the broader semi space, which we have seen, some would say the group had gone into a bear market if you look about how much it's pulled back since kind of early July. What does it tell you about where we are in the semi cycle?
I mean, when I see accelerating growth, and given they give us monthly data points and it's trending in the, the higher direction, to me, we're nowhere close to any sort of moderation when it comes to leading node chips. And look, we'll find out from NVIDIA a couple of weeks from now that clearly I think they will kind of beat and raise. The question is how much visibility they have when it comes to the customer orders. And look, this is for building inventory. Whatever TSMC is manufacturing is for building the inventory. At some point, that inventory buildup will be more than sufficient. I don't think we are there anytime close, at least this year, but it will probably be a 2025 event.
All right, going to leave it on that note. Hey, Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. NVIDIA, by the way, reports at the end of this month, August 28th. All right, let's get a look at the stocks moving ahead of the opening bell. Let's head back to Abigail Doolittle. Abby, all yours.
Well, we have more earnings movers to take a look at, Kara. Let's take a look at the shares of Akamai, up nearly 6%. They put up a really good quarter. They beat by 2% relative to adjusted earnings. They raised the forecast, very importantly, and some analysts are saying it was a clean print and that the momentum is going to continue. Taking a look at the shares of Take-Two, these shares are also higher and by about the same amount, 6% or so, just a little bit more. And Zynga momentum momentum is apparently continuing. They put up a massive, an EBITDA beat that was very impressive. Investors liking those results overall. And then e.l.f. Beauty, this is really interesting because this is the company that put up a massive beat, yet you can see that the stock down 8%. They beat adjusted earnings by 32%, sales by 7.2%, very impressive, but the outlook a little bit light. There is a 4% bearish short interest, and I think, Matt, with the stock up more than 30%, despite all of the e.l.f. Beauty products and some that I know who also buy, we're just not doing our part. We're going to have to get out there and buy more to make sure that they can keep that outlook a little bit stronger and help out the stock.
I will confess to not knowing what e.l.f. Beauty product sells.
They have the best peel ever, and their moisturizers are excellent, too.
You have no idea?
No, I don't know.
You're surrounded by women. You're married to a woman.
Well, I've heard, well, that is true. And I have two women, daughters. I've heard that if you buy lipstick, what, you're shifting down from buying like a designer dress or something?
It used to be called the lipstick index, and it still is called the lipstick index, but in signs of recession, when you don't have a lot of money to spend, you look for those kind of small purchases that give you some joy. And it used to be lipstick, although people are saying that there's a column on the Bloomberg that we've stocked up so much that maybe that's not the case.
You've got so much lipstick lying around.
Yeah, exactly.
I believe it. All right, well, if you do want to save money, you might want to go to one of the big box stores like Costco. It's going to be more difficult if you're borrowing your card from a friend or family member. We'll tell you why in Social Climbers next. This is Bloomberg.
Cracking down. All right, everybody, time now for Social Climbers. That's the companies that are making waves on this Friday morning. First up, Expedia posting an earnings beat in the second quarter, but warning that it is seeing softening travel demand now. The sentiment echoing throughout the travel industry as evidenced by Airbnb's disappointing results earlier. Next up, 23andMe is getting out of DNA testing and into the red-hot weight loss market. The struggling firm planning to launch a telehealth membership program by the end of the month. Users will be able to get a brand name or compounded forms of Novo Nordisk's blockbuster GLP-1 drug. Finally, Costco cracking down on membership moochers. The big box retailer will now require shoppers to scan their membership cards to enter stores. Guests will still be allowed, but they must be accompanied by a cardholder. The news comes on the heels of a $5 membership fee hike that is set to start on September 1st. Now you can follow all the latest company buzz. Just check out Trend, TREN Go on your Bloomberg terminal. Matt.
All right, coming up, we're going to speak with Shana Sissel, founder, president, and CEO. All of those titles at Banrion Capital Management on why this is a particularly good time for stock pickers. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have futures that are lower. After a positive finish yesterday, maybe we end the week with a whimper. S&P futures down about 0.2%. NASDAQ futures off double that right now. Let's take a look at who's ringing the bell on the New York Stock Exchange and down at the NASDAQ. You have the Bahnsen Group ringing the bell here at the NYSE. At the NASDAQ, after 1 year, you have City Girls Golf, celebrating its anniversary, getting women of color, kids of color into the sport of golf, especially in urban areas. Really cool stuff. Quick check on what the averages are doing just a few seconds into the trade. It's going to look a lot like futures did. S&P cash trade down about 0.1%. NASDAQ 100 down about 0.3%, but we're going to see a lot of volatility. Obviously, we have for the last week and change, and that could continue today. One of the stocks that you want to watch closely is Paramount. Following Warner Brothers with a $6 billion write-down on its cable networks, another sign of weakness in the linear TV business, Carol.
All right, yeah, it's interesting to see kind of the mellow, broader market trade this morning. Matt mentioning Paramount, so we're keeping a watch on that one. Also, keeping an eye on Expedia, posted better than expected second quarter results, while once again, a travel company warning of softening demand. So we'll see, but nonetheless, investors liking it, up about 10.5% here at the open. Also, we've been talking a lot about chips. We talked with our Mandeep Singh. You've got TSMC's revenue up 45%, big beat in the month of July, boosting demand for AI chips. Just a little bit higher right now, so just up about 0.7%. We'll see if those gains hold. All right, let's take a closer look at the trade and all of it with Bloomberg's Abigail Doolittle.
Well, those Taiwan semiconductor results, Carol, one reason why we're seeing a little bit of a relief rally here for this stocks, although on the day down about 0.4%, but over the last 5 days, we're looking at an up week, the first up week in 4. Coming into this week for the stocks had lost more than 20%, a bear market in a very short period of time. Of course, this has a lot to do with NVIDIA. Let's take a look at those movers. Concerns not so much around results, but more to do with the massive move that we saw for some of these movers. Take a look at AMD down 24%, NVIDIA down 19%, Broadcom, Taiwan Semiconductor, despite these positive results. So lots of weakness in this space. And again, I would argue that a lot of it has to do with the idea that these stocks went so far, so fast on the AI craze, and then a little bit of reality hitting the space. When we put this together with NVIDIA, of course, we've been tracking this chart quite a bit. Let's take a look at the NVIDIA chart that we looked at, I think probably last week or earlier this week. You can see a nice uptrend until we hit this, what's called a broadening formation, an ugly one, really, one that's expanding. That really speaks to the level of uncertainty between the bulls and the bears, more so the bulls. The bears are pretty confident that they're going to take it down. Right now, we had a breach earlier on Monday of the bottom of this range. You know, the big question here, Matt, is are we looking at what's called a V bottom, or are we looking at a bear pennant? The bear pennant would be a pause before more bearish action. The V bottom is a quick springboard higher. We haven't had that quick springboard higher, and you take a look at the RSI, not really doing all that much. I still think that this chart is suggesting to us that we're likely to go down toward that 200-day moving average around 82 once the sellers get back into action.
All right, great to get that technical analysis. Abigail, thanks very much. Abigail Doolittle, they're looking at NVIDIA. Let's talk right now with Shana Sissel. She is the CEO of Banrion Capital Management. And Shana, you make a point in your notes to us that Eric Freedman and others have been making as well, which is that as the cap-weighted S&P outperforms the equal-weighted S&P by so much, and you know over the last year it's doubled in terms of the performance, it's a great time for active stock pickers. Why is that?
Yeah, so there's this theory of dispersion of returns. And when return dispersions are really broad, which is what happens when you have these big differences between market cap, it's a better market for stock pickers. That's what the academic research shows. That's what history shows. And that's what we're seeing is the very broad dispersion of returns. And for that reason, stock pickers can really win.
Isn't it always kind of a stock picker's market, right? If you look at the fundamentals, you know, in general, or do you feel like everybody's just been buying the market? Because I feel like the market's been a little bit more selective as of late.
Okay, as of late, yes. But I think if you look back the last few years, that has not been the case. Stock pickers have not done well. If you didn't own the Mag 7, then it didn't matter. You know, how well the stocks you picked did, because not owning those hurt you more than owning other things that did well. So we've seen more recently as those names have gotten beat up a little bit, more of an opportunity for stock pickers to do well. But historically, there's these trends that happen where active versus passive, which is a good benchmark, if you will, for stock pickers versus the market, has done differently. The trend changes. So we've gone through a very long period of time where passive outperformed active. Right. And it tends to be 10 to 15-year periods where these things happen. So as fundamentals start to drive stock returns more, and that's what we're starting to see.
It's been 15 years.
That will be better
for 15 years, nobody can beat the IVV, right? Or the Qs.
That's the other thing. And Shana, the thing I was going to think about, anybody who's investing in a 401k, they end up buying the market, the index. And I always feel like even some of these big tech names, as everybody starts to say, maybe we need to kind of pull back, that ultimately money continues to be channeled into them. Doesn't that provide kind of a floor support, essentially, for all of these names?
It does, actually. And the reason why is, you know, whether or not something is good fundamentally, if there's money going into it, it's going to go up. And that's even more true as market cap goes down. But we have seen recently, especially in the last year or so, as we've seen small caps kind of struggle, that stock picking in small caps has been a huge winner for at least the last 12 to 18 months. And so that's a perfect example of what I mean. When fundamentals start to drive stock returns, then you can actually add alpha through stock selection. But in the large caps, it's much harder to do that. And that's always been the case.
I'm going to say Vertiv is a small cap here, even though it's a $26 billion stock. Because, when you talk about the mega cap tech stocks, we're talking about trillion-dollar stocks. You like Vertiv. I want to get into some of your individual picks, Shana. You like Vertiv, which is an AI play. It's a data center. I wonder if they also get, support from the infrastructure bill in the U.S. because it really is infrastructure build out. But isn't that trade already really crowded?
It's up 50% this year.
Yeah.
I don't think it's really crowded. And it's funny to me that we're going to call Vertiv a small cap.
I
remember the days when small cap was defined as under $1 billion in market cap. And I don't feel like that was that long ago. But to your point, I actually don't think that a lot of people have been paying attention to this stock. It's not one that I hear mentioned very often, but it is a second derivative beneficiary of the AI play, as it does cooling systems for these large data centers. Whereas you need more and more computing power for machine learning, you need to have, cooling for your servers because they get hot. And the more computing power, the hotter they get. So this is a stock that will benefit as we continue to build out the infrastructure to support AI. But I don't think that it's overdone at all. As a matter of fact, you said it's up 50%. Now look at that compared to NVIDIA over the same period of time, and I would argue that it's really not been bid up nearly as much as it could have been.
Hey, let's go to Apple, which is another name that you like, and it's down about 9% from the mid-July point. So we've seen somewhat of a pullback. What's the play? And that's, again, one of those big mega cap tech companies.
So Apple had some weakness even prior to the sell-off that we've been seeing in the big tech names, largely because there was some uncertainty on whether or not they were going to be able to compete with, Microsoft and others in the AI space. And they came out and they made it clear that they will be able to, but then there was some questions about iPhone sales and a number of other things. And so the stock has been weak for a while. Comparatively speaking, the stock may be down 9%, I think you said, but NVIDIA is down like 20. So it's actually held up better than some of the other mega cap names. And I actually like the stock, and I have liked the stock since we've seen the weakness in it. I think long term, Apple has like a great moat. Anybody who has an iPhone knows, like, you can't leave the ecosystem and you don't ever want to be the green bubble. So, I think that alone gives Apple an edge, and the stock is trading at a pretty reasonable valuation. So for me, it's an easy thing to say buy this big mega cap technology company. But, this is a name that I think hasn't participated as much as some of its peers on the upside, and it's not as beaten up. It's a stock that I would add to at this point.
I will lock people out of a chat if they have a green bubble. I want to ask about Novartis. All we talk about is, Novo Nordisk, Eli Lilly, GLP-1s. To my knowledge, they don't really have one there. Why do you like the stock?
So, full disclosure, I am here today because of Novartis. They have some game-changing oncology drugs. So one of their biggest blockbuster drugs, which is absolutely changing the game, is their Kisqali drug for women with advanced breast cancer. And they have a number of really blockbuster oncology drugs. So, we can, look at the sexy drugs that are out there related to diabetes and weight loss and things of that nature. But at the end of the day, it's these game-changing oncology drugs by Novartis that I think have the longer term trends in them, because, we're starting to see how things like Ozempic are affecting people in a negative way with long-term use, whereas these oncology drugs long-term use is keeping people alive, and I think that's a beneficiary. That's a benefit and a tailwind to a stock like Novartis.
Beating cancer is something that we all want to get behind, and we're glad you're here, Shana. Thanks so much. Shana Sissel there at Banrion Capital Management. Real quick, I just want to show a comp chart. She mentioned if you put up Vertiv against Novartis, and I put it up also against the Qs, it's really underperformed. So maybe it's not too.
Do you mean against NVIDIA?
Sorry, against NVIDIA. Yeah, NVIDIA is here in orange, and Vertiv is the white line there. The Qs are yellow. So it's definitely got some room to run if you think it's on the same path.
If it's comparable. And I always feel like when we talk about NVIDIA, it's kind of in its own class, and it's way ahead of the pack in terms of the AI play. But I guess time will tell, right, if everybody can catch up. All right, coming up another day, another big media company with another big write-down. Yet this time around, wait, what? It's rallying. So what gives? The media roundup when we come back right here on Open Interest. This is Bloomberg. All right, everybody, just about 15 minutes into the trade on this Friday. This is Bloomberg Open Interest. Let's get a quick check on stocks. And as you can see, we've got the S&P 500, call it little change, kind of interesting after the week that is or was almost, down about 0.1%. NASDAQ 100 watching the tech trade also just a hair lower, down about 0.2%. To the small caps, kind of the same thing, very quiet, probably low volume. We expected that kind of going into the trade, just down about 0.1%, Matt.
All right, let's get to top calls. Some of the analyst action in focus this morning. First up, Daiwa is upgrading PayPal to an outperform and increasing its price target as well. The firm says it expects the online payments platform to have another positive earnings report in the third quarter, thanks to new services and marketing initiatives. Next up, Craig-Hallum Capital is raising its recommendation on Akamai Technologies to a buy and increasing its price target there too. The software company raised its full-year forecast for earnings and gave an upbeat full-year outlook for revenue. Morgan Stanley and RBC Capital Markets are also raising their price targets on that company. And finally, Piper Sandler is downgrading Eventbrite. It's no longer a buy. The online event planning service lowering its revenue guidance for the full year and missing estimates for earnings as well. The results also prompting downgrades from Truist as well as KeyBank. Carol?
All right, keeping an eye on those analyst calls. We are also closely watching media stocks this morning. Paramount reported a $6 billion write-down of its cable TV networks, including Nickelodeon and CNN, but the company did report its first ever quarterly profit for its streaming business. The company also announced cost-cutting measures. Also looking at production studio Lionsgate shares after a miss on revenue in the fiscal first quarter. Stock just up about 1.25%. The company says it is still reeling from those Hollywood strikes that delayed its production timeline. So let's talk a little bit more about broadly what's going on in the specifics of these two companies. Bloomberg's Hannah Miller has been reporting on these earnings. You've had a really, really busy week. We know that. Paramount, help me make sense, because we've got the stock rallying in today's session. I'm thinking about Warner Brothers, 24 hours ago, that dropped about 9% on its big write-down. What's the difference?
Well, Paramount still has this Skydance deal that is supposed to be finalized in the first half of 2025. So that would be a merger with Skydance Media. And that has introduced a lot of unknowns in what's going to happen here. There's still a lot of bullishness around this deal coming through.
So Skydance is Larry Ellison's son. He's coming to buy Paramount.
I believe his name is David.
Okay. What's he going to do with the streaming business in terms of, because they're writing down the traditional linear networks, but they've got the streaming business that for a lot of companies is growing. In Paramount's case, it doesn't look like it is.
Yeah, so it's going to be all about cost efficiencies for Skydance. They've identified about $2 billion worth of cost efficiencies. And right now, Paramount is actually working to reduce $500 million in costs, including through layoffs. So we're going to see more tightening of the belt. Skydance is very big on that. So it's going to be very interesting the next few months as we see this play out.
Hannah, in general, in terms of what's going on in the media space, nothing new. We've been talking about that people are moving away from linear television, right? And then it's all about streaming. Is this just a continuation in terms of the stories that we're seeing this week?
Yes, that's right. We're probably going to see more media companies reevaluate their traditional TV networks and perhaps more
do they go away
write-downs.
at some point? Can they go away?
They still make a ton of money, right?
They do, yeah.
They're still cash cows. They're just not rising stars.
Yes, exactly. It's, investment investing more in the streaming businesses, perhaps looking at joint ventures, partnerships where you can strengthen your streaming business, combine forces. But right now, traditional TV is struggling. Everyone is reevaluating and looking at, how the market conditions have changed rapidly over the past 2 years.
Business Week just did a story about CBS, like basically having like the top shows and constantly kind of churning out things that people are watching.
But what shows are on CBS?
There's the.
It's all about
We don't know because we don't watch it.
I wrote the story. It's all about spin-offs.
I do like CBS Sunday Morning.
Yeah, there's a Young Sheldon spin-off that's coming up, Georgie and Mandy's First Marriage, that they're very excited about. There's NCIS spin-offs. It's all about using familiar characters and storylines, rebooting it, and keeping those audiences.
I was going to say, it's like
dominant.
nothing's changed
Was
for
that your story
decades.
for Business
It was,
Week?
yeah.
Forgive me. It was a great story,
Oh,
but
thanks,
it reminds you that, there's still stuff going on.
Yes.
All right, very cool. Hannah, thanks so much for joining.
You don't watch CBS at all?
I don't watch any linear TV, right? I don't
Matt's always on his phone.
really, no, I just have the Bloomberg app, and then I watch like HBO, which I guess they decided to call it Max.
Enthusiasm you
Yeah,
watch.
exactly. All right, thank you so much, Hannah. Great discussion, and I mean, what a fascinating industry this is to watch. Coming up, private equity and the peculiar rise of America's car wash obsession. We'll explain the connection next in our Wall Street Beat. This is Bloomberg.
All right, everybody, this is Bloomberg Open Interest. A quick check on stocks now that we're, 22 minutes into the trading day, and I feel like we're not changing much. Turns out I'm good at math. All right, everybody, just up about 0.25% on each of those major equity averages. We keep saying whimper. That's what it feels like, Matt.
Yeah, out with the whimper, right? But we had a decent day yesterday, and I think the key here is something that you mentioned at the top. It doesn't feel like there's a lot of fear. It's just kind of boring. I normally wouldn't say that, but I think that's good news right now.
Yeah, I think it's good that we all just kind of calm down and take stock of where we are. So having said that, you got something to do.
Yeah, I want to talk. Well, I love to take my car to the car wash. Time for a Wall Street Beat. The U.S. car wash industry is growing like never before thanks to private equity. From New Jersey to California, cities and towns are feeling the sometimes unwelcome effects. Now some have decided to slow the surge.
Car washes are taking over the U.S. With 60,000 locations across the country, it's a $14 billion industry that's growing fast.
They figured out how to cut expenses just about every single point in the journey. Labor's down, right? The footprint of real estate is down often because these are smaller facilities. The cost of water is down because they're being a lot more efficient with water. When you look at the numbers, you can see why private equity is so excited. There's about 280 million cars and trucks across the country, and they tend to get pretty dirty. Secondly, the industry is already big and growing substantially. It's been growing at about 5% annually. A firm called Leonard Green and Partners from Los Angeles began investing in Mr. Car Wash, and that really turned into a tidal wave of investment. Now there's 50 plus groups investing in these chains and really expanding them across the country. So the real strategy here is the membership model. One private equity analyst told me that if you were to change 10% of drivers to this membership model, you would increase the industry's profit from 2 to 3 billion on that front. Big cities have seen an incredible growth, so much so that you're seeing these so-called saturation bans take effect there, where municipalities are pushing back and saying, hey, I think we have enough car washes, we can slow down a little bit.
All right, I have a membership at my car wash because I go so often.
Of course he does.
There are no unwelcome effects for me.
Don't you like washing your own car? Didn't you grow up washing cars?
I sometimes do, but I do it so often that I just don't have enough time to wash my own car every time. So I'll go to the Charles Oakley, the local Scarsdale car wash.
This is not a paid endorsement.
Whenever I can.
Matt is not a paid spokesman for
It's a basketball player. No. Anyway, I think it's really fascinating that private equity is getting so big into this. Mr. Car Wash is one I used to go to in Berlin, so it's a global chain.
You know what's interesting? I saw this statistic that more car washes were built in the last decade than all the preceding years combined. That's a lot.
Yeah, well, we have a lot of cars on the road.
And people aren't doing it themselves.
And people keep their cars longer and longer, so you know, if you're not going to buy a new one, the next best thing is like new wheels or wash it. And
it's also kind of an easy spend, I think, in general, right? Like it doesn't.
And it's a little bit.
Depends on where you go.
It's a little bit expensive, right? Unless you're a member, like you can spend $40, $45 with the full wash and then a little bit of a hand wax and dry at the end. Okay, we got to go. Speaking of autos, coming up in the next hour, we're going to speak with the CEO of a website on which I spend many hours every week, CarGurus. Plus, we're going to talk about something that I really love, which is sandwiches.
Sandwiches. Well, that's later on.
Yeah.
And salads.
We're going to talk to the CEO of Potbelly later on. In terms of what you need to be watching next week, on Monday we get the New York Fed one-year inflation expectations. On Tuesday we get PPI data, and we get earnings from Home Depot as well. Wednesday we get CPI data, so a lot of inflation, and then earnings from Walmart and Deere next week. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Carol Massler. Katie Greifeld and Sonali Basak are off on this Friday. Coming up, everybody, a turbulent week in markets draws to a close with debates on what's next for stocks, bonds, and central banks. Also, the week ahead brings a slew of economic data as investors search for more signs of resilience in the world's largest economy or for some weak spots. And with fears that U.S. consumer spending is softening across the board, we will get the view from the C-suite twice this hour with the CEOs of CarGurus, a car shopping site, and the sandwich chain Potbelly. So you get a sandwich and then you jump in a car.
I love it. I love it. Let's get a check on what's going on with the markets. A little bit of a whimper to end the week, at least for now, right? The volatility has proven us that we can see whips around, but the S&P 500 is down about 0.3% after a positive finish to yesterday's trading session. You have the NASDAQ 100 right now down about 0.5%. The U.S. 10-year yield coming back down. Yesterday, we briefly went above 4 on the 10-year yield. We're still holding up there in the 2, but the 10 is back down to 3.93.
Yeah, just a tease there, right there. All right, it's a busy week for economic data coming up. We get New York Fed one-year inflation expectations. That's on Monday, followed by some key inflation data on both Tuesday and Wednesday. And then, don't forget, we get retail sales data. That comes your way on Thursday. And then the University of Michigan consumer sentiment, that will come 1 week from today on Friday. Cameron Dawson is Newedge Wealth Chief Investment Officer, joining us on how equity markets are positioning. Cameron, this is a market that does trade from, I feel like, economic data point to economic data point at this point. But what's front and center for you in terms of what's next for the stock play?
Yeah, it certainly is that growth story, which is that we continue to see this narrative ping pong versus growth falling off a cliff or everything's perfectly fine. And certainly that's why data next week will be watched so very closely. Because if we are going into a weaker growth environment, it does suggest that you would need to see GDP and EPS forecasts cut. And usually when you're cutting forecasts, you're also derating multiples. But if growth is more resilient, then of course, maybe we can make those growth forecasts. Then it's a question, of course, of what that means for the Fed. We've been hearing from the Fed this week that they don't seem to have the same urgency as bond markets. So when you put it all together, we do expect this equity market volatility and bond market volatility to continue.
All right, in terms of the Fed and really the inflation picture, I want to focus in on, Cameron, because you point out that as inflation comes down, we don't see companies with a lot more pricing power. Now, earnings season has been great, right? But Delta, Pepsi, ConAgra have all come out with reports that point out they just can't raise prices anymore. The consumer is done with it. Is that a problem going forward?
I don't think it's a problem for the Fed. It's actually really good news on the CPI front, but we do think it's a problem for corporate profit margins. One of the things that we've learned over the last few years is that inflation is really, really good for corporate earnings. It gives them pricing power. It drives top line revenue growth. It allows them to be able to pass on input cost increases to the end customer. And result is margins are better. But if you go into an environment where you're hitting a wall and how much you can raise prices, it means that companies are having to eat these input cost increases, which is why we think margins are the biggest watch item as we go into 2025, because we continue to hear from companies that they just can't raise price anymore. It pushes more more pressure onto volumes to deliver. But what we're also seeing is that they're having to cut price in some areas in order to get higher volumes. So it just makes watching that corporate margin line ultimately important.
So super important. Hey, Cameron, I want to ask you, because last month you guys, you were on and you said for fresh capital, we look at quality names and laggard indices, value, international, small cap, but don't chase junk. I guess what I'm always interested in a week like we've had, how much of your thinking about where to place fresh capital, how much of that has changed?
Certainly taking some air out of growth multiples has helped. And we did do some upgrading in quality, even in our growth portfolios, where we took advantage of prices coming in significantly and some positioning also coming in. But the message still here is that we think that you have to remain ultimately focused on quality. We think that we're still in this rather uncertain economic environment, which means that junk may rally in a short period of time because yields fall. But if you do actually see economic weakness come to bear, it just means that yields could be falling for a bad reason and junk can reverse all of those gains. So super disciplined about valuation, but also very, very focused on quality.
In terms of what you want to stay away from, Cameron, are there any other shoes to drop? You know, we saw the carry trade pop up over the last week, and I think many people probably hadn't been watching for that. So are there other positioning worries? Are there any brown swans? What keeps you up at night?
Well, one of the areas that we still see positioning is fairly stretched is within large cap growth and the mega cap names, which just means that we shouldn't be all too surprised if there is more volatility there, because you're still sitting with positioning in the 96th to 98th percentile, which just means that people are still very much on one side of the boat. The good news about the last week is that where we were seeing positioning overall be in extreme levels for things like short Japanese yen or long US equities, they've moved out of extreme. They're still stretched, which just means maybe a source of continued volatility, but not nearly as stretched as they were at the beginning of the week.
Cameron, bottom line, do you invest like a recession's coming at some point?
We don't invest specifically in anticipation of a recession. What we tend to find is that defensives that do really well during recessions tend to have what we call episodic volatility to the upside. So you get a burst higher as everybody surges into your traditional staples and utilities, but they tend to give it all back up over the course of the recovery, which means that for very long-term investing, our preferred approach is to focus on quality. We see it as an all-weather kind of investment strategy, where we may lag in times where junk is doing really well, but over the course of the entire economic cycle, we can invest with names that have defensive qualities to them, that blocking and tackling from company management teams, without having to be in typical defensive businesses, which of course lag when you have a big rally to the upside.
What about value? We had a guest on last week who pointed out that over the last 11 elections, value outperforms growth for the 6 months after the vote. Do you like value here?
We like value for incremental capital, but it has to come with a very sharp focus, again, on quality, because a lot of the value index has very low quality names in it that might get a short-term boost. Maybe it does last that 6 months. But buying something just because it's cheap has certainly not worked over the long run, at least in the last 20 to 30 years. So what we try to do is marry within value of some left behind areas where we see light positioning. We like the business models. They do trade at discounts to the overall market. And then that allows us that if you even get that short-term pop, you participate in it, but you don't give it back on the other side when things start to move on.
I got to say, Cameron, it does feel like everybody's kind of a lot calmer than how we started the week, a little quiet. So
calmer
I feel like
calmer than you are, dude.
I feel like then that opens the door for me to ask, what's with the astronaut behind you?
Spaceman?
Oh, this is Newedge's unofficial mascot. So this is our lobby in Stamford, Connecticut. And so we have our spaceman mascot.
I love it.
We need a mascot.
That's very cool.
I want a mascot.
Well, we do. We have fish. We have fish all over the building.
Oh, that's true. That's true. All right, Cameron, thank you so much. Have a great weekend. Cameron Dawson of Newedge Wealth joining us right here on this Friday. All right, let's get a look at the stocks moving at this hour. Let's get back. It's really quiet, but let's see what Abigail Doolittle is watching. Abby.
Yeah, there's quite a bit of action, Carol, for the chip space, actually. Taiwan Semiconductor, trying to get my words out on this Friday, now higher by about 0.6% after saying that sales in July did surge by 45%, continued AI demand for those chips. But not so long ago, this stock had been down, and earlier in the pre-market had been higher. So lots of uncertainty in this chip space, as you can see, with NVIDIA down just slightly, but the fluctuation, the uncertainty of what is ahead relative to the big rally that this stock had at one point, up 180% into its peak so far this year. AMD down 1.7%, and Intel, which is really in a bad way, down more than 70% over the last year on continued issues, down 3.6%, a key area to keep an eye on. As for some individual movers and turning to more of a bright spot, let's take a look at Eli Lilly, up 5.6%. This after gaining nearly 10% yesterday on that blowout quarter and guide. It's not every day that you see this kind of strength continue, but we are seeing that for Eli Lilly. So just really want to remind everybody of the buyers continuing to step into Eli Lilly and the idea that Zepbound and Mounjaro are very strong. Investors want a piece of it. And then finally, this is really interesting to me, Matt. Take a look at the shares of Expedia. I know that you guys have been looking at it before, up 7.77%. This after a 12% earnings beat. Sales were better. They are warning of soft demand, but investors looking past this. And the reason this is so interesting to me, it seems everything else or a lot of other companies related to travel, whether it's Airbnb or TripAdvisor and so many others, American Express saying that experience and dining is weak, and the shares of those stocks being punished a little bit after talking about that kind of weakness. Not the case with Expedia. Investors looking right past it on this Friday.
Yeah, it's interesting. I noticed that yesterday, last night too. Carol and I broke these earnings at 4 o'clock with Romaine. You know, they go through every single company that puts out earnings. I noticed that too, and I thought maybe they took their lumps already, Abby, but they're actually up 10, 11% for the week.
Yeah, it's hard to know exactly what it is that investors like about this story so much relative to the other ones. Maybe the fact that the company is a little bit larger and also in so many different areas of travel that diversification perhaps makes it a little bit easier for them to weather that storm. But the management themselves, that company, is saying that they are seeing some weak demand. So, and just to put this gain into context, this is great. Take a look at this on the week, a tremendous week, up 11%. So sometimes in a tough market, investors go where the strength is, go with the momentum to the upside, and this seems to be one of those plays this week.
All right. And meantime, you look at something like Airbnb this week, and it's down almost 10%. So a very different story, even though, you know, similar
Well, they don't
stories.
have the diversification that Abigail mentioned. I think that's a really important point. Abigail Doodle, thank you very much for that. Abby giving us a look at some of the individual stocks moving this hour. Coming up, we're going to talk about CarGurus, putting the pedal to the metal.
You don't like cars, do you?
In its latest quarter with an earnings beat. We'll find out what's driving the strength. See what
they did
company.
there?
Yeah, the CEO is going to join us. Jason Trevisan. This is Bloomberg. Let's get to high interest now. Look at what's making headlines around the world. China has lodged a complaint with the World Trade Organization over the European Union's decision to impose anti-subsidy duties on Chinese electric vehicles. The move comes after the EU placed tariffs on some car imports from China as high as 48% last month, and it escalates a dispute that's straining the relationship between the two global powers. It's been a tough couple of years for Wall Street bonuses, but a new report suggests that might be about to change. Bankers are set for bonuses to swell by as much as 35%, according to compensation consultants Johnson Associates, with debt underwriters standing to see the biggest bump of all. And top executives from Citadel had a hand in giving two giant pandas a home in San Diego. Ken Griffin and Peng Zhao, CEOs of Citadel and Citadel Securities, respectively, were lead donors to the San Diego Zoo Wildlife Alliance to prepare Panda Ridge for the bears' arrival. And we thank them.
They look so sweet, but, you know, don't get close.
No, they'll rip your arm off.
They will,
Yeah.
indeed. Can we talk cars?
Yes, let's talk about company news right now. Online car sales platform CarGurus making its third consecutive quarter of double-digit growth, sending the stock off to the races here. You can see it's up almost 20%. The company's CEO, Jason Trevisan, says, quote, "Our marketplace business continued to accelerate, achieving the largest quarterly revenue increase since 2021, driven by higher adoption of add-on products, continued migration toward premium subscription tiers, and expansion in our global paying dealer base."
What does that mean?
There's a lot of CEO speak there.
Yeah,
Let's talk to the man himself. Jason joins us right now to talk about the quarter that was. Is it a global business? Are you looking at a global dealership revenue flow?
It is. It's global in the sense that our marketplace exists in the U.S., Canada, and the U.K., and so we consider that global. It's
a service, I have to say, that I look at almost every day. What I love about CarGurus over the competitors is that you can filter out for so much. However, I have a couple of questions. If I look for example, a manual Ferrari or Porsche, a lot of sellers disguise F1 and PDK transmissions as manual, even though there's no stick. They're just flappy paddles. The same is true if I look for a convertible Corvette. A lot of sellers will say a coupe is a convertible because the top is removable. Is AI going to help us solve these little glitches?
It sure is, and we have been trying to solve those glitches for a long time, and we've done a good job at it. We get inventory feeds from tens of thousands of dealers and individuals on literally millions of cars, and it's very messy data. And we've always considered ourselves a search and a data business, and so we have cleaned that ontology, we call it, and made sense of it to try to provide the best search results possible. AI is making that undeniably better. We're using AI in upper funnel searches to help people understand what type of car they might want, and not based on deciding between car A and car B. They're saying, I'm a father of 3, I live here, and these are my activities. What type of car should I like?
Oh, that's a great point.
We're also using AI.
Yeah.
Almost no car has room for rear-facing car seats. Like, almost none.
Which is crazy.
Yeah.
Because you have to have them. Hey, Jason, I care what Matt is buying and what cars he's interested in, but what I really care about is what consumers are doing, because there's some, color commentary in terms of it looks like consumers are trading down, maybe looking for a deal or looking for a cheaper car. What can you tell us about consumer sentiment?
Yeah, consumer sentiment right now is all about vehicle affordability. With interest rates high and the fact that used cars and new car prices are both about 30%, 35% higher than they were pre-COVID, consumers are having a hard time finding cars that they can afford. So affordability has really skyrocketed to be the #1 factor that consumers look for. We see that on our site. We're the largest automotive marketplace in the country, and so we have the most shoppers, we have the most inventory. So we have the best view as to all of the shopping trends, and consumers are looking for lower priced cars and stating that affordability and reliability are their 2 #1 drivers.
Anything there, though, Jason, that tells you that maybe a recession's coming?
We fortunately, even in varying macro environments, dealers need to sell cars and consumers need cars. They may hold on to them longer. They may drive them longer, but they still need to buy used cars. We don't think that a recession is coming from our perspective. We don't see the signals for it. And when we look at some of the macro signals, our expectation is that it will be a softer landing. But we certainly see, while consumer spending remains high, they're looking to spend less on cars.
I wonder about the headline prices. For the most part, what you see is what you get, but I've noticed that dealers from Long Island, New Jersey, and Chicago are the worst at adding thousands of dollars of fees in the small print. How do you get around that? Because it's not a great customer experience if you think you're getting, a GLS for $49,000 and then you find out at the end of the deal it's really $59,000.
Totally agree. That's a terrible feeling. So we do a lot to try to fight that. So the first thing we do is we have dealer ratings, and that allows consumers who have that experience to voice and share that. And dealers that do that on our site will absolutely see a lower deal rating, and as a result, their search results will not get shown nearly as much. The second thing we do is we kick dealers off our platform. If we find out that dealers are doing that, if they have hidden fees, then we will not allow them or their inventory to be on our platform.
Hey, one other thing I want to ask you about, because we have talked a lot and done a lot of reporting here at Bloomberg about the interest in car buyers for hybrids over EVs. What kind of color can you give us around that debate?
We see the same, or the shopping behavior that we see on our site is similar to what you're seeing in the headlines, and you just gave a great example of that. That doesn't affect the financial results, say, of our business as much, because whether a dealer is selling a hybrid or an EV, we're helping them understand the consumer trends in the market, how they can turn their cars faster on their lot, and giving them intelligence on pricing. We're also at the same time giving consumers the benefit of other consumer reviews of cars. We're allowing them, like I said before, to compare cars better than we ever had before and really help them find the right car for them based on what matters. And that's where AI is playing a big difference. Historically, a consumer would need to know, this is the type of car I want. Now a consumer can say, these are the 10 most important things to me. Help me find the car.
I just want to say dealer ratings, 2 thumbs up. I think you're right about that. It works well. One question about Carfax versus AutoCheck. Carfax is great, and you can click through and find out right away if it's been in an accident, how many previous owners, etc. AutoCheck always leads me to a screen where they want me to give them $20 or $30. Why even use the latter?
I can't speak to the value propositions of those two businesses. I think understanding the history of a vehicle is incredibly important. We do everything we can to give as much information on not only the dealers, like we were just saying, but on the cars as well. Because it is, when you're buying a used car, there's a lot of information to know, and we do everything we can to empower the consumer as much as possible in what is can be at times an overwhelming purchase process.
All right, lots of fun. So enjoyed checking in with you, Jason. Thank you so much. Jason Trevisan, he's CarGurus CEO. Forgive me, stumbling because I'm looking at the share price. It's up 17%.
Yeah, it's absolutely ripping face right now.
Last night I was looking at the year to date. It was down on the year, and now it's up on the year just because of the surge that we're seeing. A bunch of analysts too upping their price target on the name.
The earnings report impresses, and it's an addictive platform, I have to say. If you start spending time on it.
From someone who knows.
Yeah.
This is what he watches. He's not watching streaming or TV. Anyway, still ahead, superhero success at the box office. Has Disney splashing the cash abroad? Ugh. It's Friday. I'm having a trip.
This is a movie, like all the kids love this.
We're going to explain it today's Social Climbers. Getting it out here. This is Bloomberg, and this is Open Interest. Yeah, don't you watch?
I don't watch comic book movies.
You're missing out.
Yeah.
It is time now for Social Climbers. The company's making waves on this Friday morning. First up, Disney breathing some new life into superheroes. After the breakout success of Deadpool and Wolverine at the box office, Disney plans on spending $5 billion in Europe to produce movies and TV shows over the next 5 years. Next up, Amazon has a new secret weapon in its same-day delivery operation, a fleet of Kia Souls. The boxy cars will handle quick deliveries that the company currently delegates to its Amazon FlexGig economy service. The move is designed to give the online retailer more control over its deliveries. Finally, McDonald's is hoping to tug at Gen X heartstrings and their purse strings. The burger giant is introducing a new collector's meal that include collective cups featuring brands like Hot Wheels, Hello Kitty, and Grimace. The promotion comes as McDonald's reported its first sales drop since 2020. Matt, is that going to make you buy?
No, but I love Grimace.
All right, who doesn't? You can follow all the latest company buzz on TrendGo. Just check it out on your Bloomberg terminal.
All right, looks like we're starting to see a little bit of a turnaround in markets here, at least some green on the screen if you look at the S&P 500. Let's get a check on what's going on in the markets with Abigail Doolittle. Abby?
Well, it is, of course, Friday, so on a weekly basis, it's interesting. Right now, we're looking at the possibility of an up week for the NASDAQ 100. It would be the first in 5 weeks, but the S&P 500 on the week still down about 0.5%, but off of the lows as markets today. To your point, do turn around a little bit. I think a key driver for next week will, of course, be that dollar-yen at the lows, down 3.3% as that carry trade unwound. It does look like there could be some more ahead of that, just looking at the charts, but right now you can see that dollar-yen down just slightly. Crude oil getting a nice bid, and then take a look at this 2-year yield backing up about 14 basis points, back above 4%. Now, I was just mentioning the NASDAQ 100 possibly having an up week. If we put this into the context of the last month or so, the selling that we've had for these indexes, the Russell 2000 is the one index that has a small gain. You can see that the NASDAQ 100, the SOX, and the S&P 500 all down quite a bit. The SOX, that chip index, that pressure from NVIDIA and some of these other ones, TSM, notwithstanding today's positive results around the July sales surging, AMD really dragging on that index. And then there's the NASDAQ 100 and the S&P 500. I suspect next week it won't just be the yen that will be key in these chip stocks. It will also be some of the data. On Tuesday, we're looking at U.S. PPI, and then Wednesday, CPI, and then Thursday, U.S. retail sales. And then, of course, Friday, University of Michigan expectations for the month of August. So these could be big drivers. And then there's one earnings mover, Carol, that we have not talked about yet today, and it is surging. That is Sweetgreen. Take a look at it here on the year, up 209%. The last time I looked on the day, up 27%. They put up a good quarter. They beat the sales. Importantly, they raised the full year guide. Key metrics very strong. And there is a 14% short interest. So I suspect that some of this move, and certainly some of this parabolic move today on those very good results, well, probably a bit of a short squeeze.
All right, Bloomberg's Abigail Doolittle, thank you so much. Got to say, I love a salad for lunch, but is it still salad days for the consumer? Let's put that question to Potbelly CEO Bob Wright. The fast casual chain just reported its 13th consecutive quarter of year-over-year retail margin growth, and he joins us on this Friday. Bob, great to have you here with us. Talk to us a little bit about business, how it's going, and what you are seeing from consumers specifically, if they are still spending.
Yeah, it's great to be with you. It is a challenging time for sure. The consumer is, you know, they're focused on managing their wallet after all these years of inflation, and then we see what others are seeing. Their wages haven't quite kept up with that, so they're just doing some trimming. And you see restaurant visits under a little bit of pressure, especially from more infrequent consumers. But in our quarter, we were up in sales 0.4% on top of 12.9 a year ago. We built 4 new shops. You mentioned our 13th consecutive quarter of shop margin expansion, so the profitability is there for us. And you know, Potbelly is really about a long-term growth strategy, especially through franchising. So we think we put another quarter in place that built on that promise of the capability of the brand to grow.
We do want to talk about that build out and that franchise model. Go back to comp sales, as you said, up 0.4% versus almost 13% a year ago. Why is there such a big difference?
Well, a lot of it is what I think you've seen in the industry starting this year. The January turn in the consumer behavior definitely kind of came to be with all of our customers and the restaurant consumer more broadly starting in 2024. And what we've seen in particular is our less frequent and less digital customer is the one that may be looking to peel back some visits, not with Potbelly. There's not a value challenge with Potbelly, but just in general, they're managing their overall spend and turning to the refrigerator maybe once or twice more often than they had in the past. So that delta in sales growth for us is, and the challenges for us this year is rooted in that consumer. I will say, however, the digital side of the business for us continues to grow, and that's reflective of those customers that we do have a more affinity-based relationship with. In fact, 40% of our business now comes through digital channels. Pre-pandemic, that was in the single digits. And it's up 200 basis points from last year. And the majority of that 200 basis points of growth is people moving from third-party digital channels into our Potbelly-owned digital channels. So we're very pleased with what we control. But there's no question that the broader consumer and those that are a little less loyal to a lot of different brands are looking for reasons to hold on to those visits. That's why we rolled out our $7.99 skinny combo this quarter.
Right. A little bit more
at the beginning of this quarter.
A little bit more expensive. You know, some of the fast food chains, which I'll differentiate Potbelly from, you know, like a Burger King, McDonald's, Wendy's, obviously, but they're going at the $5 price point. Why do you pick $8?
Well, I think when you see a lot of, especially the fast food chains, and do significant discounts on core items, the amount of business that it takes to overcome the break even on that is significant. And what we did is we studied what our consumers are actually telling us. Those less frequent customers said, look, if you can get me below $9 at lunch, that makes a difference in my decision making. And we believe going below $9 all the way down to $7.99 made an even bigger difference from them. In fact, those customers that have ordered that $7.99 combo, it's a full meal. They're not looking for a discount on something that still leaves them hungry after lunch is over. They want to have a meal, and they want a good value, and they want it to make sense with the rest of the menu. Those customers that have ordered it from us give us 7 points increased scores on value and a 5-point bump on intent to return. So it's doing exactly what we wanted while still being healthy for our overall business.
You know, I'm sure you don't watch your stock price on a daily basis, or you're not going to run the business to change the stock price on a daily basis, but you've outperformed Sweetgreen since they went public. We've got a chart here, and your stock is has come down since the beginning of the year. What do you think needs to happen to turn it around and boost it back up?
I think we're in the middle of that transition, and particularly the growth investors are looking at our stock, and they're looking for just a few more proof points over the next quarter or two that the growth is really there. When we started as a primarily company-owned business model to shift to franchising and to get that franchise growth acceleration really moving is something that not a lot of brands have seen, and not a lot of investors have seen that done successfully. We're in the midst of that success. We have 663 open and committed shops. More than a third of those, or about approximately a third of those, are those committed by franchisees to build. They're on track with their development commitments. Not only that, but when they're opening shops, they're opening them at volumes that are better than they expected and higher than the system-wide average. But I do believe that a lot of the growth investors are just watching for another quarter or two to see that that unit growth development truly is part of the story, and that the rest of our execution with digital, with operations execution, our ability to continue to deliver a great menu is part of that transition.
But just to go a little bit further, Bob, I mean, with a stock that's down 31% so far here in 2024, that's got to put a little pressure on you guys to watch overall costs. So how are you incorporating that kind of into the financial picture?
Yeah, we talked about that last quarter and this quarter. Look, we're a pretty straightforward investment. Our adjusted EBITDA and the multiple that we get rewarded for being a growth company is pretty much where our value comes from. And so protecting that profitability, you might have seen in Q2, we made $8.5 million. It was the very high end of our guidance range, even with a little more of a difficult top line. How do we do that? Margin extraction at the shop level, again, a record 13 quarters there. And then we're meeting our G&A. We're being very careful not to trim areas that are going to feed that growth, but we think it's our responsibility to manage the overall P&L and make sure we're finding profit extraction in the short term to hold that profitability to the year.
Bob, last question. You mentioned 40% of the business is digital. I mean, do you anticipate that at some point it's a lot more than that? What's the business model going forward? Is it also important to have the in-store or in-restaurant experience as well? Give me an idea of percentage breakdown, though, over the next couple of years.
Yeah, I'm so glad you asked. We haven't set a target on where we think digital should be or where we desire it to be. We're not an online business like maybe a pizza business or wings or something that, trying to move almost all of their business digitally. Our in-shop experience is very important to us. And frankly, people order digitally and still experience their meal consumption in shop. They can order for pickup and walk to a table and go ahead and consume their meal. It is reflected in our prototype. We've shrunk our prototype by about 500 feet to reflect that future, but that prototype still has seating. It still has that great Potbelly feel inside the shop, and it still allows for people to use us the way that makes sense for them. I do expect our digital business to continue to grow, particularly because of the Perks loyalty program that we have. We see frequency improvements in every single cohort in those Perks customers. And we think that's the engine that keeps building the digital. And then, of course, catering. We had a great quarter in catering, and that continues to move into the digital space as well. So I think those two will be the key drivers of digital growth, but we have not set an arbitrary goal to set it at a specific number.
All right, going to leave it on that note. Listen, have a great weekend. Bob, we appreciate it. Potbelly CEO Bob Wright joining us, and shares of Potbelly right now up about 4.6%. All I'm going to say, Matt, is I'm hungry. Yeah.
We'll go out and get lunch as soon as this program's over, Carol.
All right, coming up, the domestic economics of international trade. Michael Strain of the American Enterprise Institute on how free trade affects jobs. That is coming up next. This is Bloomberg Open Interest, and this is Bloomberg.
Time now for our daily Wall Street Week conversation. One thing that Democrats and Republicans have agreed on is America's need to be more competitive with China. But the parties' trade policies still differ. Wall Street Week's David Weston asked the AEI's Director of Economic Policy Studies how trade policy is being used to contain China.
In terms of a bilateral trade deficit, not the trade deficit between the United States and the rest of the world, but the trade deficit between the United States and one other specific country, in this case, China, tariffs can be more effective. And if you look at the bilateral trade deficit between the U.S. and China, what you saw is that it did go down. But it really kind of matters how you measure trade deficit. And so the measure I'm referring to just counts the number of goods coming to the United States from China. If instead you want to look on a value-added basis, so of all the stuff the U.S. imports, how much of the value added, how much of the different stages along the supply chain in any given final good came from China? And there you see that the trade war with China was much less effective at reducing trade with China. Instead, what happened in a lot of cases was that, China provided a lot of the value in the manufacturing of a certain good. And then China shipped a product that was almost finished, but not totally finished, to another country, to Mexico or to Vietnam. Mexico or Vietnam put the finishing touches on that product. It comes to the United States. That is technically not an import from China. It's technically an import from Vietnam or from Mexico. But China, may have contributed 90% of the value or 80% of the value of the manufacturing of that good. And so, really, we're still importing from China in an economic sense. It just doesn't show up in the official bilateral trade deficit.
Michael, in your paper, you refer to Jake Sullivan's talking about a new Washington consensus, because it feels increasingly like both Democrats and Republicans are kind of moving away from free trade. Make the case for free trade. What do we expect? What do we get out of that? What's the case on the other side of the equation?
So, a lot of politicians talk about trade as a jobs program, and I think that's the wrong way to think about trade. What trade is really about is consumption. What trade is really about is productivity. What trade is really about are higher wages for workers, higher incomes for households over the long term. That's why you want to trade. You want to trade because trade allows each nation to specialize in that nation's comparative advantage. That makes the workers in that nation more productive. That makes them more valuable to businesses. That makes businesses compete more aggressively for them. The way businesses compete more aggressively is by bidding up wages. So now you've got higher wages, higher incomes, and higher living standards. That's the way we should be selling trade. In terms of the level of employment, that's really a job for the Fed. The Fed's job is to make sure that we have maximum sustainable employment, to make sure that we are at full employment consistent with inflation being low and stable. And so if you have a period where you've got, too much unemployment, the Fed should be stimulating the economy to get people back to work. If you've got a period where you've got too much inflation and you've got excess labor demand, the Fed should be cooling things down trade really doesn't have a lot to do with that. Trade really doesn't have a lot to do with the level of jobs in the economy. Trade is not about how many people are working. Trade is about what are workers doing. And if you allow free trade, what you're going to get is a situation where what workers are doing is what they are best at, what they are most productive doing, and that's how you get higher wages and higher living standards.
So speaking of the Fed is very much in the news this week after those somewhat disappointing jobs numbers last Friday. A lot of talk about rate cuts, maybe even emergency rate cuts, things like that. So how is it doing right now from your perspective? Before those jobs numbers, you said it was too early to really be cutting rates. Do you have a different view now in that balance between unemployment on the one hand and price stability on the other?
Yeah, so before we got the last jobs report, in my judgment, it was premature to call for the Fed to cut in September. I thought the right thing to do was to wait for more data, to wait for a couple more employment reports, to wait for a couple more inflation prints, and to wait for more of the weekly data that comes in before making a call. Maybe the right thing to do would be to cut. Maybe the right thing to do wouldn't be to cut. But where the economy was prior to the last jobs report looked like an economy that was too strong for rate cuts. And it looked like an economy where the relaxing of overall financial conditions, stock market boom, creating a lot of wealth that drives consumption, that dynamic, the market was doing a lot of the Fed's work for it.
And that was Michael Strain of the American Enterprise Institute talking with Bloomberg's David Weston. Tune in to Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg. Back in June, a mystery investor made a record $2.7 billion wager on long-dated treasuries, creating waves in the ETF market. That investor has now revealed himself as Brent Schutte of Northwestern Mutual Wealth Management, and he says that the firm's recession call is very close to happening. Joining us now is Bloomberg's Emily Greifeld for ETF Friday. So what, he bought TLT in size?
Yeah, it was the largest TLT inflow ever. And this was back in June. But this really excited the ETF crowd because TLT was a fund. This is BlackRock's 20-plus year Treasury bond ETF that people were just timing wrong. All of 2022, people were piling in, and then it performed really badly. And then when it was performing well, people were flowing out. So this actually seemed like a pretty good trade. At least for right now, he's up almost 3%, but it's been a very volatile week.
So what is he saying now?
So now he's saying he bought in June thinking a recession is getting closer. Now he said we're inching ever closer, just looking at the recent economic data that we've had. So he's going to hold this, he said, at least for a year, 18 months. And this is a bet that he's making on behalf of retail.
I was going to say, walk me through this trade, because it's not like Northwestern Mutual is like, hey, let's make a $3 billion bet.
That's right.
They hold a lot of client assets, right? So is it spread among retail accounts?
It's spread among retail accounts. So that's why it's $2.7 billion. It's not like this was one trader sitting with all this money and investing it on behalf of himself. But he's the chief investment officer of the wealth management business, so he kind of oversees what's going in and out.
As someone who watches the ETF world in a week where I feel like, we're talking about the Fed needed to make aggressive cuts right now, and we're thinking about recession, or I feel like we're talking about a lot more, how do you think about his move against kind of the broader ETF space?
Well, I mean, it's been a volatile week, so I think this was a well-timed trade, at least for now. We'll have to see how it works out. But it's been very interesting because we haven't seen an escape, like a rush to the exits in the ETF space. We've actually seen net buying on the week in terms of equity ETFs, and we're still seeing a lot of buying in these speculative areas of the market. There's
Seriously?
a 3x semiconductor ETF, so it goes 3 times leveraged a semi index, and it's been getting inflows like almost every day.
That's
billions of dollars.
That's
so
wild.
I think that's at least one sign that there's still bullishness in the market even after the week we've had.
TSMC would say, I told you so, right?
That's
Based on
right.
what they came out with today.
All right, Emily, thanks so much for joining us. Emily Greifeld there. You can tune in to ETF IQ. That program airs every Monday at 12 p.m. Eastern to learn more about the industry. Let's get, though, to the trading diary, what you need to be watching next week. On Monday, we get the New York Fed one-year inflation expectations. By the way, we're hammering this in because these eco data points have really been driving big swings in the market, especially when it comes to inflation. So Tuesday, we're going to get the first piece of inflation data with PPI. Earnings come out from Home Depot. On Wednesday, we get more inflation with CPI, and then earnings from Walmart and Deere on Thursday. So a lot going on.
See what it does to shape the trade next week. Let's get to what's happening on this Friday. Let's get a quick check on the markets. Folks, some green across the board. A little bit higher, just up about 0.2% on the S&P 500. NASDAQ up about 0.1%. Very quiet today. And taking a look at the 10-year note, just down a hair, if you will. We're looking at a yield of about 3.94 here. So kind of quiet.
Was that hair comment on purpose?
Oh my God, what is that?
So
who let them in?
We had, other than today, it was a roller coaster week. And Carol has joined me today. We have experienced roller coasters in the past together. In fact, we were on air together during the Great Financial Crisis.
Right.
This is, I think, from 2010.
See what the crisis did to you?
Yeah, I lost all of it. I was already in the process of losing my hair. But, you know, I thought a lot on Sunday and Monday about the time that we spent together on air, because I was used to coming on the program with you and saying, wow, the Dow has fallen 1,000 points.
It's really interesting because we were on air together on Monday, certainly on Bloomberg Business Week. And it was interesting because you said, you know, watching what was happening in Japan overnight made you a little bit worrisome. I have to say, it didn't feel like the Great Financial Crisis, where you have to watch kind of the financial industry. Do we start to see strains within, you know, lending and so on and so forth, things slowing down? That would get me a little bit nervous. Having said that, we'll see what the data brings next week. But
yeah, one thing that we're hearing from everyone we talk to about any kind of comparison to the GFC or LTCM is that you don't have the kind of leverage embedded in this market that you did then. Certainly not for the consumer. And that should be...
Slow your roll is what they're saying.
Exactly. Coming up next week on Open Interest, we have a busy C-suite for you. Mark Bristow of Barrick Gold and Kate Johnson of Lumen. This is Bloomberg.